Uh, yeah, so I just want to introduce John. I've known him for, I feel like a few years now, right, John? It's been maybe 3 or 4 years. I know definitely from the 2017 crypto run. and I met John through another friend, a good friend, Andy. And it's just been, I was very amazed when I met him. I've never met anyone so passionate about the markets. And I really was attracted to the energy and just the joy he had for understanding the markets, for trading, for the stocks. And I was just fascinated when I met him. And from that point, I think we've become friends, John, and I've just learned a ton from you. And so I wanted to thank you from that, for that publicly right now with a lot of my friends and family here. You've really helped change the way I approached even trading. And I was kind of, we talked a little earlier that you try to do it on your own and then you mess up and lose a lot because it's a very difficult game to understand if you don't know what you're doing. And I was getting like, I would have these highs and lows and it was very stressful. I think Anna's on here somewhere. She could probably tell you, I couldn't sleep some nights, I'd be like really scared and everything. And I think just understanding some basic principles from someone that's a professional that does this every day and really wrapping my head around it really gave me the energy to continue to learn, to continue to get better. And now I love it, I enjoy it, and I want to continue to get better and learn, but I'm not in that fearful state anymore. And in fact, it's an exciting thing to me. So I appreciate that, John. Just your energy and your love for this, and also I'm really grateful that you're able to be here to walk through this with us. So with
Anytime.
that, I will pass it over to John Bocek, and he's going to share his screen.
Hey, Pablo, I do appreciate that. And I will say right off the bat, you can see that I'm getting blinded by some sun in about half an hour that'll be past. So I'm going to lean into the camera too close probably for everybody.
Yeah.
But no, I do appreciate that. And yeah, so for tonight, of course, we're going to talk about the economy, which, I'm amazed how many people have shown up, because if someone were to tell me that, I would probably go, that sounds as exciting as watching, paint dry on the wall, I guess. But it actually is really exciting. It sounds boring because I think to your point, maybe to your point, Pablo, is a lot of times for any subject, if we don't completely understand it, or more to the point, if we feel like it's such an abyss of so much information, how can we even begin to wrap our minds around it? Plus, I mean, even within an hour, how can we cover what really is meaningful in the economy that means anything to us? I think most people believe that. And so I would love to start by just saying today is, I've been doing this for an extremely long time and it is my life. It's the only thing I know. But I'll tell you right from the get-go, it is actually quite exciting. And I hope to at least kind of get that across tonight. But we're going to go through some pieces that, as I'm explaining it, may come across a little dry, because we're going to talk about the pieces of the puzzle. And explaining the pieces of the puzzle is like explaining what a nail is and what a screw is. And that can be a little bit dry. But I think where it gets exciting is if you understand those pieces. And as we get to the end of this, we're going to bring it all together and show you how these pieces come together to build a machine that is called the economy, and how it relates to all of us, and what it means for your investing, for your saving, for your spending. Everything we're going to talk about tonight, if you understand or can retain even half of what we talk about tonight, you will know more, which is a sad commentary. You will know more than probably 90% of financial professionals that I work with.
Wow.
And that's a true commentary. I actually do presentations all the time for financial professionals, and some of the questions that come out of their mouth, I'm like, this is your job. You should know this. But my point is this, is we're going to go through this systematically tonight. And Nico, you tell me how you want to handle questions. But I'm actually, typically I've done this in even smaller forums where we're talking to 2, 3, 4, 5 people at a time. So it's more of a conversation versus me talking. And so if you have questions, if you want me to go a mile deep on something, I can talk pretty quickly, believe it or not. I'll be happy to do that. And
Yeah,
I
John.
will also say, even though we have more, even though we have the hour block we're looking at, I can stick around till 1 a.m. If people want to stick around and ask really deep questions, even personal, like, hey, what do you think of this, that, whatever it may be on the economy or your investments?
Yeah,
Awesome.
John,
Yeah.
I'll,
Oh, go
I'll
ahead,
say
Pablo.
real quick, Nico. At the end, we usually have a pretty wide open time for questions and let people stay on. But just based that this topic could be, as you're going through one piece, there could be questions. We could put them in the chat, and then maybe when you're ready to switch from one kind of major section that you feel it's a good stopping point, I think it's appropriate to take a few key questions. If we see a theme, Nico, of questions,
Yeah.
let's ask those main questions. That way it's not, somebody's a little bit confused and then we continue down, right? So we'll stop at every like major section, John, and just ask,
Yeah,
answer.
I might jump in and just ask you a question here and there,
Right,
John. And
right. Nico does a good job of just kind of representing the conversation. But if you guys do have a question, feel free to put it in the chat. Anyone on right now, we can as we're going through this, feel free to put it in the chat, and we'll do our best to address it. If not in the session, we can do it right after as well.
Okay. Yeah. So don't hesitate to grab a pen and paper too, and write, jot down notes on this, because honestly, even if you don't understand it, if you write down some of the basic things we talk about tonight and just let that sink in, again, you'll be ahead of the vast majority of even financial professionals. I've worked in this world for long enough. I can tell you that for certainty. So if you can see my screen up here, here are the topics that we're going to cover. And you've probably heard these terms at least once in your lifetime, such as GDP, which is a measurement of our economy. And we're going to talk about that because it's not quite a measurement anymore, that since 2009. We're going to talk about inflation. You probably hear that on the news. If you listen to the news, is inflation. And I think most people get the idea that inflation, it sounds like costs of goods and services are going up. That's actually not what inflation is. So we're going to talk about what real inflation is and what it means to your investments, what it means to your money sitting in a bank. We're going to talk about the actual dollar. A lot of people think dollars are money. They're actually not. So again, I'm going to dispel a lot of things that people just kind of are born into these myths that are not true, and hopefully make it fun while we're doing it. Then we're going to talk about some really technical stuff. The Fed fund rate, or the overnight rate. It's basically when you hear about interest rates going up or down. That's what they're referring to. Don't worry, we'll get into that. And then lastly, the 10-year Treasury rate, which dictates every aspect of your life, whether you know it or not. So with that, we're going to start with GDP. Nico, I'm going to lean on you for a couple of things. What I'm going to ask questions kind of general, and as the answers roll in, or yes or no, is I'd love, just interrupt me. But I would love to know, does anyone not know what GDP is from a high level? Because we're going to talk about that. But have you heard of GDP recently in the last year or two, whether it's in the news or radio or? And if you wouldn't mind in the chat, just responding to Nico, and then Nico just interrupt me if there's anything that I need to delve in there.
Yeah, I actually think it'd be great for you kind of even to explain what the definition is, or I know me and Pablo were talking about it this morning. Pablo, you had a couple of great examples of what GDP is, but I think a good definition would probably be helpful. I'm sure most of us don't know what that is.
Yeah, absolutely. Yeah. Okay. So GDP is going to be the first explaining what a male is, right? So again, I'm very well aware that some of this is going to be dry, but it's very important, and it really is. So bear with me on a couple of these things because again, it does get interesting. So GDP has traditionally been the ruler or the measurement of how we measure the health of an economy. It stands for gross domestic product, right? And we're going to talk about what it actually means. But GDP, if you see my screen here, what I've done and what I like to do is I don't like to use my company's material. I like to use third party like Google or even the Federal Reserve website so that you can replicate exactly what I'm looking at, and it's not proprietary to us. But GDP, if you'll hear it on economic news here and again, and especially if you start doing investing and trading, you're going to hear it. And a lot of people kind of go, I don't really know how that applies to me. Well, let's talk about that. Again, GDP is the ruler, the measuring tape, whatever you want to call it, to measure the health of the economy. Or it used to be, up until 2009. Since 2009, GDP is no longer, or let me put it this way, should no longer be the state or the measurement of the economy. And I'll show you why. From a very high level, the mathematical equation, sorry for bringing math into this, but the mathematical equation for GDP is GDP equals the supply of money, the amount of dollars that are floating around in the world, really, times the velocity of money. Now, what in the world is that? So supply of money is simply what it sounds like. It's the amount of money that's been printed. It's just the amount of money. Velocity of money is the measurement of money changing hands. So as an example, if a company pays me dollars, that would be a measurement velocity of 1. If I then go and buy something with that from someone else, like Pablo, that now money has exchanged hands, that'd be a measurement of 2. So velocity would be 2. And that doesn't really matter. The idea is velocity is the measurement of money changing hands. So why is that important? Well, GDP before 2009, and I'll explain why this is, the money supply, meaning the amount of money that was in the economy, was relatively, and we're going to look at a chart here in a moment, was relatively stagnant. Meaning, if I can find it here, there we go. So here's a chart from the Federal Reserve Economic Data website. So again, this is the Federal Reserve's website. Yeah. And so what this is showing is the money stock, the money supply. And we can go back further, but you can see that, yes, every year in the 70s and the 80s and the 90s, money did increase. And even though this may look drastic, it's actually not. It's a very small amount. So the point of that is money supply relatively stays stable or low. So what GDP really is if money supply is a non-event, meaning let's just assume that it just stays flat, even though we know it doesn't, but let's assume it stays flat, GDP really equaled the velocity of money, meaning GDP was measuring how quickly money was changing hands. And we know that in healthy economies, when people are making a lot of money and spending a lot of money and making more money and spending more, well, velocity is high. Money is changing hands quickly. Banks are lending, people are spending. And when economies are bad, people as a whole tend to hoard money in bank accounts and investments, those types of things, and money does not change hands. And therefore, GDP obviously goes up when velocity goes up, GDP goes down when velocity goes down. So let's take a look at that. We talked about, I said this was a real measurement of the economy because we could measure how money was changing hands all the way until 2009. Now, why is that? When 2009 came and we had the Great Recession, we had the Great Experiment. We call it stimulus checks now. The real name is quantitative easing. And before that, it was called Keynesian economics. The idea that you can print your way out of trouble. Now, it's never worked before in any other country, but hey, maybe it'll work this time, right? And did it work? I mean, did it work? Did it get us out of 2009? And what I'm going to show you here, again, you're going to see, no, it did not work. Matter of fact, what we're going through now is only building upon the wreckage of 2009. And you don't need to take my word for it. It's all in data. So let's look at this. Money supply through the 70s, 80s, 90s. Yes, we grew a little bit. And we're going to come back to that and see how that affected our investments back then. But let me fast forward a little bit to 2009. Okay. So as you can see, we had the Great Recession of 2009. And we decided, wait a minute, we should try this Keynesian economics. We'll call it quantitative easing, and we'll have even a better name called stimulus checks, meaning printing money, sending it out. And in essence, you can see the money supply shot up.
Skyrocketed,
exactly. And I'm actually going to go out a little further here. So 2009. So we printed money for years and years and years and years and years and years. I mean, many quantitative easings over those years. So the money supply just went, compare that, went astronomical. Wow. So very interesting, right? So if we went back to GDP and we say, okay, that's interesting. If GDP equals the money supply times velocity of money, even if velocity of money, meaning even if people after the recession never came back to buying anything, GDP must have been amazing because the money supply was up. And of course, let's put it this way. If velocity of money is 1, meaning it didn't change, and we see the money supply obviously went up, let's say it was a 10, GDP should have been 10, but we never heard that. So what happened? Well, let's go to GDP. Here is GDP in the 90s and 2000s. Here's 2009. And if you remember, actually, I don't know if anyone even knows this because most people don't. After 2009, we did not get GDP above 3% until 2016. And you can see that here, 2.6 in the ones and the twos until 2016 here. 7 years of GDP growth being stagnant and below 3, which is very bad. But wait a minute. If money supply skyrocketed, shouldn't GDP be like 5, 6, 7? So basic math means, okay, if money supply skyrocketed and GDP stayed very low, what happened? Velocity of money must have tanked. Well, don't take my word for it. This is all bookmarked, right? It's all measurable. Let's see. I gotta figure out how to get this. How do I get the Zoom window out of my way? How do I get the control panel off the top? Make it go away.
I think you can just
Oh, I can drag it.
drag
Fantastic.
it. Yeah,
Great.
grab
All right. All right. I'm a WebEx man myself. All right. So here we go. Here's the velocity of money.
Oh, John, can you just point out also those gray areas in these charts represent the recessions?
Good point. Good point. So each of these gray bars is a recession, just to put this in perspective. And we'll come back and we're going to talk about this a little bit later. You know, everyone always, forevermore, is always shocked when we have a recessionary drop of the markets where we see 60% pullbacks in the stock market, which are typical. We see them almost every 10 years.
Yeah.
You can see it. Yeah, of course, we saw it in 2000. We saw it in 2009, 2090s, several times in the 80s, 70s. These aren't uncommon yet. You know, enough time goes by that we're like, oh, wait, what's this? But here's the velocity of money. And the point is simply this. Let me fast forward. Here is the recession of 2009. Look at the velocity of money after 2009. Velocity of money continued down, 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 down. What does that mean to you and me? What that tells us is even after 2009, even though the stock market came back, and there's a way to trade this, but even though the stock market came back, the economy never came back. A matter of fact, every year the economy got worse after 2009, meaning people were not buying as much every year. They were hoarding more, they were spending less, money was not changing hands. Very interesting, right? Because we look at the stock market as a reflection of the economy. And I'm here to say something that's always controversial when I talk to anybody, is especially my own clients and my businesses, the stock market has and will never reflect the economy. It does reflect aspects of the economy, but it does not reflect the economy. And this can be shown
as
here.
a whole.
So anyway, the point of showing you this is this idea of printing lots of money has implications, has impact on everything that we do. And we're going to talk about that. But let's go back to this for a moment. Is we talked about the money supply in 2009. That was the first time we tried this great experiment of quantitative easing, also known as stimulus, here on this scale. I'm trying to get my windows out of the way. There we go. So what happened with coronavirus? Watch this. 2009 looks like nothing.
Wow.
So let me put this in perspective for you. In the last 18 months, or however long it's been at this point, almost 2 years, we have printed over $3.5 trillion. That means pretty much nothing to nobody. What does that mean? We have printed almost 35% of all US dollars ever printed in the history of the United States in basically the last year and a half. Very important stuff. Most people don't understand necessarily what the impact is to the economy, but they know it's probably not good. And I'm going to show you exactly what the impact is to the economy. But the point of it is, here's coronavirus, or here's basically the shutdown. Here's the printing. We have now shot this up, and yet GDP is terrible. Well, we know the equation. GDP equals money supply times velocity. If GDP is still pretty bad, and yet we had this massive shoot up in money supply, what would velocity look like? Pretty much the inverse, right? And that's what we have. And I'll zoom in here. So this is, whoops, a little too far. There we go. So this is the velocity of money. Now, a lot of people don't realize this. We obviously dropped in Corona. We got some stimulus out. And ever since then, you would think that the economy is opening back up. People should be spending, yada, yada, yada. Data doesn't show that. The news may tell you that. Data doesn't show that. The data is actually saying no. Velocity is actually getting weaker and weaker still. So now there's something to be said that, yes, when we fully open, don't we expect more spending to occur? Yeah, and yes, we do. We absolutely do. And that's actually a problem when it comes into inflation. And we're going to talk about that. But in essence, we're going to wrap up on GDP. So start throwing your questions at Nico. But as you're doing that, I'm just going to just kind of capstone this piece. And again, thank you for bearing with me. This is probably the most boring piece of it all. GDP, again, it equals the amount of money we have in the economy times the movement of money, because the amount of money has always been stable before 2009. Really, GDP just measured the movement of money, but that hasn't been true since 2009 when we started injecting large amounts of money. So when you hear GDP these days, it's a fugazi. It's not real anymore. Really, what anyone should be talking about is the velocity of money. And you'll never hear that on the news. But the velocity of money is the true measure of an economy and how money passes hands. So don't be fooled if you're getting into investing or in investing and you hear GDP numbers. You can kind of scoff at it and go, huh, okay. But it's
Wow.
important to know that.
John, question. So like, it almost feels to me like is it like we're almost trying to stall like the inevitable in a way of like we're just printing money to like we just don't want a recession to happen, so we're just trying to make it last as long as possible.
Oh, we're going to talk about that. So make sure you write that down. I'm going to address that, but we're definitely getting out over our skis on that question. So I'm going to
Okay.
come back to that one.
Okay.
All
We
right.
have some questions, I think.
Okay.
Yeah.
What would be a long-term implications of printing so much money? Another recession question mark?
Good question. Okay.
That's one question. And then
No,
the next,
keep going. I'm gonna write these down too.
if we don't use GDP anymore, what do we use now?
Yeah, good question. Well, unfortunately, so if the question is what are they using, they are going to continue to use GDP because it's all they know to use, right? If you were to, first of all, when you say GDP on the news, does anyone really know what anyone's talking about? They just know, oh, hey, it sounds good, because the newscaster seems happy about the number. So they'll continue to use that, because can you imagine them logging, whatever news station we're listening to, saying, hey, the velocity of money, you'd lose your audience in 2 seconds. And I'm glad I haven't lost you all. They're going to continue to use that. But really what you want to go do is just, all you have to do in Google is type in FRED, which stands for Federal Reserve Economic Data. It's their data. It's not some third party having a bent on it. And then just type in FRED velocity, and it will literally bring up the page we're looking at, and you can monitor this quarter over quarter over quarter. So
okay, we got some more questions. Oh, go ahead, Pablo.
And I am going to address that first question about money. I'm not skipping that question. I'm going to bring up a drawing tool here in a moment to answer that question.
Cool. I just want to share something that helped me understand this. A quick analogy that made me understand this a lot easier. It's like if you think of a bar, right? A bar that is hopping on a Friday night. There's a lot of drinks being ordered. There's a lot of activities. People are meeting each other. There's groups showing up. There's food going out. There's waiters. There's a lot of transactions going on. That's high velocity. There's a lot of money exchange going on. Now imagine that velocity is at a standstill, but then at the end of the night, you add up all the cash and there's a lot of cash, like as if it was a good night, right? So you'd be like, wait a minute, this bar was slow. Like there wasn't a lot of people here. It's a slow bar. You got one guy that's ordering a drink every 30 minutes. Yet at the end of the night, the output of that bar was still high. And so that really helped me to kind of identify like, okay, so velocity of money is just transactions happening. When that's happening, things are going good. Everybody's kind of winning in that, in that model. But at the end of the day, they measure the total output of that bar. And so if the bar velocity is slow, yet the output is still relatively high, you have to start asking, how is that possible? And to John's point, the equation is, well, the money supply. So somebody came and brought a lot of money or printed money out of thin air and said, here is actually your output. So that's one thing I wanted to share, just that analogy. And then the other thing is that GDP historically, whoever has the highest GDP has been traditionally the global power, which is another, I think, a big factor, John, because we don't want to lose that positioning. China's right on our tail, going at basically double the rate. They're like, I'm looking at the data now, it's 6.9% that they're going, and we don't have to get into China, John, but I'm just saying, I think politically as well, it could look bad to be losing on the GDP, measurement, so to say. So anyways.
Absolutely. All right. So I thank you, Pablo. I appreciate that. So I'm going to go into my handy dandy drawing tool because I'm high tech over here. And so I'm going to answer that question. Oh, wait, Nico, are there more questions before I jump into that?
There's a lot more questions.
Okay.
But yeah, we can get into some of them. Let's see. Have other countries also printed money related to COVID? How does this affect us globally?
Yep.
Okay. And then yeah, go ahead.
Okay.
Dan had a comment. He's like, I'm dumbfounded. I had no idea. My biggest question is the fallout of this. The explanation was thorough and informative. Thank you, John. Are there any other measurements of the economy other than GDP? And Ryan asks, what is your opinion on investing in foreign markets in countries with high debt owed to the U.S. right now?
Ooh.
Um,
That's a good question. I love that question. I will say that's a longer segment that I think we will tie into the next one, Pablo, if that's okay.
Sure. Yeah, of
I
course.
actually have an entire thing just on that, literally.
Awesome.
But that would take up more time than we have.
Okay, and then last one is, what is the relationship of money printed with the national debt? I think they're very tied together.
Yeah, no, great questions. Okay, and I will say that one I thought ahead on. So, national debt. I hope you like this. So yeah, I'm going to address all of this. I'm going to kind of go off what my pattern was. I'm going to go freehand and draw some things here for you here in a moment, which I think will be actually more exciting. I keep using that word. I think it will be. I think you'll be excited. I think it'll generate a lot of questions. So I'll probably stop every 5 minutes to see what questions are coming in. But to answer the question about debt for a moment and what the relation is, you'll notice that our debt to GDP right now is basically 130%. Now, what does that mean? That means our debt, our country's debt to our GDP ratio. Now, the only other time that we were above 100 was after World War II. Now we're above that right now. Also, I want to put this in perspective about printing money. We printed more money in the last 2 years than we did in both inflation adjusted, by the way, inflation adjusted, meaning if the wars were right now, World War I and World War II, if they happen right now, the amount of money we spent adjusted for inflation is less than we just printed. So I want to put that in perspective.
Wow, man.
Now, there was a question: Has other countries done? Are they currently doing this? Have they done this? Yes and yes. In 2009, and we're going to look at charts on how that reacted to the stock market. If we don't have time tonight, we'll do it in the investment portion, because that's all of the pieces we're talking about makes it so easy to trade. It's ridiculous, but you have to understand these pieces. So the idea is when we print money, and I'm going to draw this out, it weakens our dollar. But if other people are printing, because our dollar is weak or strong compared to other currencies. So if we're weakening our currency, but others are weakening their currency, are we really weakening anything? And there's an interesting answer there. But more to the point, if like in 2009, we weakened our dollar, and I'm going to show you this in a chart, but I'll be very quick about it now, because this may probably be a different thing. In 2009, we started quantitative easing way before any other country did. We started printing, and through 2009 to 2016, we printed a whopping $870 billion, which we thought was insane, which is a drop in the bucket. We just printed 3.5 trillion, like what billion, hey, please, carry the T. Who cares? And we thought that was insane. Now, what happened was our dollar got pushed down. And of course, we'll talk about this: when the dollar grows weak, the stock market goes up, and it will answer the question, why does the stock market keep going up when the economy is not great? And we're going to talk about this, but understand this relationship. When the dollar grows weak, the stock market does go, or it doesn't have to, but it puts a lot of pressure on the market to go up. When our dollar this last year was devalued by 15%, the market in the same time frame went up 18%. That's not by accident. That's not because of a strong economy. That's because of the relationship between the dollar and the stock market. Okay. And we're going to get into that a little bit later, hopefully today. But understand that, and that answer, a lot of people ask, well, I don't understand why the market's doing so well. It shouldn't, right? And it has nothing to do with the company's numbers. It has to do with what we're looking at as far as the dollar is concerned. So to answer your question here, is the debt to income ratio is typically what happens is countries that maintain over 100% for the course of a year or more, not always. Again, we do have Japan and there's a couple other things that countries that do this. They typically do lose the reserve currency. Now let's talk about that. I'm going to jump into the dollar, which will address all the other questions, Nico, that you just had. I'm sure this will even generate even more questions here in a moment.
Awesome.
But let's talk about a few basic things. If you have a pen and paper, I would probably jot this down. I'm going to freehand it with a mouse. I probably should have got my pen out.
John, this is so good, man.
I appreciate it.
This is awesome.
So a couple things. Let's talk about the dollar first and foremost. I was going to go down one route. We'll keep that there. I'm just going to draw a circle here. Oh no, I am lagging. Give me a second. That is a terrible circle. I might have to get my actual drawing pen out here. Give me one moment. Just gonna wipe the slate clean. And if anyone has trouble seeing what I'm about to draw, just let me know. Okay. If this lags, yeah, it's lagging. All right, sorry, having some lag issues on my part. Let me log into a different system for my drawing tool. Okay, much better, faster. Okay, so what we're going to talk about is basically the cycle that we're in. Now, this is why it's exciting, is we are literally living through historic times. And what I mean by this is, as we just looked at, and why it was important to look at these charts, we've always printed money in low sums. Starting in 2009, we printed a lot of money. This time, insane amount. First time in American history we've ever seen this amount of money printed. First time-ish was 2009. I'm not sure that even compares at this point. So we've never seen this in America, but it's historic here. We've seen this numerous times elsewhere. Where? Well, it was only 1944, not that long ago, that the US became the reserve currency, the dominant currency. That wasn't that long ago. Who was the dominant currency of the reserve currency before us? The pound sterling. The pound sterling was based out of London. We have to remember, London was the powerhouse of the world, business, military, economics. They were America. I mean, they were the powerhouse. What happened, and I'm going to give you a terrible version of this, because this is a whole lecture in and of itself, the history of the pound sterling. But of course, when we went through World War I, is countries were all back, the currencies were backed by gold. All of us were backed by gold or some precious metal. And when war broke out, countries stopped the convertibility, meaning they said you can no longer take your currency like the dollar bill and convert it for the gold, which was backed, because we may need it for the war. Got it. So they stopped the convertibility, except for the pound sterling. They said, no, we don't want to lose our reputation, known as creditworthiness. So if you want your gold, you can have it. Well, you can imagine a lot of people wanted their gold. So there was a run on gold and they didn't have enough. Now, you may have heard of a bank called JP Morgan. Well, the son of JP Morgan back in the day when World War II came around after that said, hey, if your guys going to do the same thing, you're going to run out of gold. And basically they were running out of gold. And so JP Morgan's son convinced America to lend them our gold, saying, hey, we'll get interest, we'll get our gold back, we'll get profit back later on. And since Americans can't convert their dollars to gold at this point, we don't have a worry in the near term. Well, long story short, what was occurring is they could no longer hold that convertibility through World War II because they were running out of gold. People wanted the gold. So they started printing, this does not sound familiar, printing pound sterlings way more than they could on gold. And they de-linked from gold in essence, because they printed more pound sterlings than they actually had gold in the bank. So when Winston Churchill tried to get back onto the gold standard, that collapsed, that began the collapse of the pound sterling as the dominant currency. Because when you print, you devalue. It is no different than every supply and demand everywhere. Meaning, if you jump on Amazon and you want that item, and there's only 10 of them, I know that Amazon doesn't work this way, but in theory, it would be very expensive. But if that same item, there was millions of those items, there's not a rush, and they probably want to sell them. The prices go low. No different than dollars. The more you print, the more you devalue your dollar. So to answer your question is, what is one of the fallouts of printing this much money? One of the major fallouts of printing this much money has been, and I'm going to put at the top here of this cycle that we're in, is P for printing money. One of the fallouts, I'll bring it up here on this chart, is let's look at the dollar. It's called the Dixie, DXY. It's our US dollar compared to other world currencies. So since we started printing up here, we dropped the US dollar. It may not look like much, but this is about a 17% drop in the US dollar's value. Now, that brings us to the next point. We hear this idea that inflation, and I'm kind of skipping around a little bit, but bear with me. And if you have
John,
questions,
is 17%, how significant is that? Is that pretty significant?
It is.
Okay.
And it can compare to some other times, but let's talk about that for a moment, because what happens then is that brings us back to this idea of inflation. So we talked about GDP, and then when we talk about, okay, what is the byproduct of printing money? It can be inflation. So again, has this happened elsewhere? Yes, it happened to the pound sterling. Also happened in Weimar Germany, right? After the war, they had to pay war reparations. Well, how'd they do that? They tuned up the printing press, added new ink, started printing money, and the marks, they created hyperinflation, meaning they devalued their dollar. We'll talk about that, which meant that, hey, if you're devaluing your dollar, it takes more, devaluing your currency, it's going to take more currency to buy said product. Okay. Now we call that inflation. But most people think of inflation as, hey, well, why is my milk going up 50 cents? Why is this computer going up $100? That's not inflation. Because milk did not become more valuable. When we were kids and milk was what? I don't know, 50 cents, 75 cents, I don't know, whatever it was. Now it's $3. Milk didn't get more expensive. It's still worth the same amount. It's that our dollars are actually worth less than they were. It's a different way of looking at it, but it's the appropriate way of looking at it. Okay. It's very important to understand this. Now, why is that? Well, we looked at that chart. Every year, even before 2009, the Fed was printing a little bit of money every year. When I say a little bit, enough, because how do you achieve? Remember, it's the Fed's goal. I mean, this is the reasoning behind it is debatable. Their goal is to have an inflationary target of around 2.5%, right? So how do you do that? Well, if you're not getting inflation, you print more money and you devalue your dollar. It makes it says, oh, well, now you need more dollars. So let's think about this in terms of the stock market here for a moment, because I want to kind of relay this to what it means to us. Stock market. Now, this is something that if you understood this concept back in the day, you could have made a bundle through this beautiful tear up. It's simply this. And don't get me wrong, it won't be the last time it happens. If we know, because they tell us ahead of time, that they're going to do a lot of printing, and we know that devalues the dollar, and we'll talk about that here. Well, the stock market, funny enough, is the first reflection of perceived inflation, whether there is or is not. And the reason for that is we buy stocks, or rather institutions buy stocks on what we believe they're going to be worth between 6 months and 18 months down the road, depending on the stock itself. That's why when you look at a stock and you see this thing called a PE ratio, price to earnings, it's literally what's the price of the stock based per its earnings. And sometimes we're paying what, 10, 20, 200 times, meaning you're paying 200 times what the company actually earned that year. It's not because it's worth it at this point. It's because you believe it will be worth that. So the point is we're buying stocks based on what we think the future worth of it will be all the time. So in the meantime, here we come along devaluing our currency between 15 and 17%, depending on the time frame you're looking at. But let's round it down for even conversation, 15%. Well, all of a sudden, as institutions, we go, well, we believe Apple, Microsoft, yada, 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 are really worth this price. Now, that's another conversation on whether they really are worth that. But assuming they are worth the price that they are at, and we're saying, well, hey, we're devaluing the dollars we buy it with 15%. We now say, okay, you owe me 15% more dollars for my stock because you devalued your money. And that pushes the prices of stocks up. Hence this amazing run since we started quantitative easing or Keynesian economics. You may also hear it in the news as modern monetary theory. That's the newest term they like to spend. You never want to stay on the term too long because it gets a bad name. So, yeah. Okay, so let's go back to this. So printing money. I want to make sure I answer all these questions here. Printing money, what happens is, as I mentioned before, devalues the dollar. The more money you spread out there, it devalues the dollar. So you have the dollar being devalued. Now, as I just explained, inflation, and I want to pause here too. I meant every 5 minutes. It's been like 15 minutes. This is going to be an important concept, the idea of inflation. Printing money does cause inflation. Again, not because it's making products cost more. It's because now you're needing to take more of your dollars to buy said product because your dollars are worth less. It's no different than any other country, including all the way back to the Roman Empire. Being real quick about this, they had gold and silver coins, and as their conquests and countries, grew and grew and grew, they didn't have enough gold and silver to make their pure coins. So over the course of 2 decades, and that was it, 2 decades, they whittled their way down to a point where they were dipping bronze coins into silver, which made them worth very much less than they had been. And therefore you had to carry so many more coins to buy said produce or whatever it may have been. And that was one of the major contributors to the breakdown of trade routes because of the cost wasn't there. It was the cost benefit. That's an oversimplification, but that was a major contributor. Human history repeats itself from then to now. So let's talk about inflation here, but I want to pause. Nico, any questions so far?
No, any questions, guys, about what are you talking? None yet.
Okay, and if they come in, I'll stop. So I want to explain this. This is probably the biggest sticking point these days is this idea of inflation. Again, the target is 2.5%. Let's not forget really quickly that in the 1970s, not too long ago, in 1971 to 1981, we saw inflation go from low single digits, not unlike what we had been going through, to 1981, where we saw inflation almost reach 20%. So what does that mean? 20% means that year over year, your products and services were going up on average 20% year over year. And that's the government's number they gave you. As I mentioned, the US dollar just dropped basically 17%. And yet the government's saying that inflation's 5.5% right now. Well, does that make sense? If your dollars have lost 17% of their buying value, is inflation really 5.5%? And the answer is no. And that is a whole conversation I'd be happy to get into afterwards on how that makes sense. But be careful on that. The true inflation number is not the number they call CPI. True inflation is the value of your dollar. You can look this up on Google or at Yahoo or anywhere. It's called DXY. It's the dollar. You can track it. So inflation, you may have heard over the last several months or years, if you listen to financial news, that they believe inflation is transitory, right? Come and go. Is it really? Well, the answer is yes and no. And the reason for that is simply this. There's two types of inflation. This is very important. There's the normal nominal inflation that we all are used to in our lives, and that's simple supply and demand. Meaning, let's say there's a product out there and there's just a stable demand for it. But then COVID comes along and supply and manufacturing drops off the map. Well, even if demand stayed stable, not even went up, prices of these products would then go up because there's limited supply. That's just normal supply and demand type inflation. And then when supplies get fixed, when manufacturing gets fixed, that pops back up and prices can normalize. Not always, but they typically do. So when you hear the Fed talking about inflation being transitory, meaning, oh, don't worry about it, costs and goods and services will come back down.
That's what they're talking about.
That's what they're referring to. Now, that in contrast is different than what we just talked about, which is called monetary inflation. And you can look this up. Monetary inflation is different. It's exactly what we just talked about. If you print large sums of money, even small sums, but if you print large sums of money, you devalue the dollar, needing more dollars to buy products, meaning those products cost more dollars. You cannot unprint dollars.
Right.
So that inflation is not transitory. Don't take my word for it. Take the Fed's word for it. Last year, they said, hey, we're not worried about inflation with this printing. Our target's 2.5%. We're not worried about it. All of a sudden, a few months later, we got to 3%. They said, don't worry, it's transitory. Now, what does that mean? Let's use their definition. We believe it will be gone by the beginning of 2021, meaning they thought it would only be a couple months. That came and went, and then they changed their term. Well, we don't believe it's transitory, even though you do hear that in fits and spurts. They now say it's temporary. And they say, yeah, we believe, and they said they came out earlier this year, it's temporary, it'll be gone. We believe it'll start coming down in June, July timeframe of 21. Well, their measurement of inflation went to 4%, then 2 months ago, 5%, and this month's reading was 5.4%.
Wow.
Now, is the Fed dumb? No, they're not. The Fed, the last Fed, all the way Greenspan, you keep going back. It doesn't matter. Their job is to be positive in the face of the world burning down. Because if they say one negative word, you will tank bond markets, stock markets. You will tank everything.
Be chaos.
So their job is to spin it. My favorite thing, and I took a screen capture of it last week, a news article came out that the Fed said inflation is now a positive thing because it means increases in wages. So we went from not worried about inflation to transitory to temporary to it's a positive thing. All right. So let's just wrap our minds around that for a moment.
Wow.
So inflation is here. Now, there are things that can damper inflation. Any one of these items is actually its own like symposium, right? But just as long as you understand the concepts of these things. So one type of inflation is transitory. That's the normal supply and demand that they will harp on because that's the positive spin on it. But monetary inflation is here. They can kick the can down the road in a couple ways, some complex things that are pretty cool to talk about, but it's good that the piper will be paid. What's the fallout from it? The fallout is inflation, right? But let's talk about this. We've now, for the first time in American history, backed ourselves into the corner that every nation that has lost its reserve status has backed themselves into. Now, what is it? This brings us to this piece. Inflation results in you can only combat inflation with the Fed messing with interest rates. And in the interest of time, I won't go back to my PowerPoint for looking at this, but you may have remembered this is, and if you don't, I'll explain this. I almost feel like this really could go on for hours and hours if I delve into this, is when the economy slows down, how you stimulate the economy is the central bank, meaning the Federal Reserve, lowers interest rates. By lowering what they call their Fed or overnight interest rate, it can also allow banks to lower their rates. The point of that is when the economy gets into trouble, if rates are low, it can allow businesses to recapitalize their debt, refinance their debt so that they owe less each month, can spur on the economy. It allows individuals and businesses to borrow money, to spend money. The idea is if you make it easier for people and companies to borrow money, you will then get money moving again. You'll get that velocity going again. That's the idea of lowering rates. So every time we saw a recession, every time we see a recession, they lowered rates down, 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 and down. But you can only go down so far, you would think, right? So let's bring up the 10-year Treasury yield, which is really the important rate.
We have a couple questions, John, whenever.
Okay, yeah, let me just show this one thing and then we'll address that. All right, so I'm really going to do a really far zoom out here. This is interest rates, guys. 1981. Do you see a clear trend line of interest rates?
Wow.
So, look, every time we get into trouble, what do? Lower interest rates every single time. Well, we then last year dropped to a 0.5% interest rate. And to put that in perspective, that's the lowest it's ever been, including the Great Depression. Okay. In Europe, they actually went to a negative interest rate. And we may get there, but let's pause for questions.
Okay. Let's see here. Is it incorrect to think of inflation as a form of taxation?
Oh no, that's not incorrect at all. That's dead on. Let me spend 1 minute or 2 minutes. I would say 1 minute. If I say 1 minute, probably means 5. Let me talk about that for a moment. Many administrations after the fact have written about how they used inflation to pay down debt. This administration, I expect to be no different. This is not partisan. This is bipartisan. This goes both ways. And the reason for that is simply this. Let's talk about another piece that's adding to inflation is unemployment benefits. Is it intentional or not? Not here to make political comments. But look at the actual circumstances. If you're the unemployment benefits in general are targeted towards low income earners, and probably rightfully so. But if you add up the unemployment benefits for the majority of folks who are getting them, they can and do add up to about $20 an hour. When we look at small businesses, the small business report that came out this last month, July, the month we're in, showed the greatest price increases across small businesses, across all industries of small businesses since 1981, 40 years ago. That's a form of inflation. Why is that? Well, it's human nature, unfortunately. And I would tell you this, I'd probably fall in the same boat. No, I'm not judging anybody. If someone's like, hey, you can stay home for $20 an hour, or hey, I will pay you $20 an hour to come to work, and you have to pay taxes on this. Federal, state, social, federal, whatever. I'd be like, I want to spend time with my family. So no, thank you. What about $25? Probably still not enough for me to move. What about 30? Okay, maybe I get off the couch for 30 or 35. But the point of that is it's forcing small businesses to raise their quote unquote minimum wage, even though it's not a legal thing. Now, on the surface, that's like, well, that sounds good, right? No, small businesses, not tech businesses, but small businesses, let's look at restaurants, operate on a business margin of about 10 to 15%. There's not a lot of margin there. Do you think they're absorbing that price? Absolutely not. When we are doing, when they have to pay more for people to come in, it then spikes the prices of the products and or food that they are selling. And therefore, we have even another contributor to inflation. So the idea is, okay, was this intentional? Well, I can't speak for this administration, but many administrations throughout history, all the way back to the 1930s, have used inflation to pay off countries' debts. Meaning, okay, if people are now getting paid more, that means even though the percentage of tax is staying the same, even though we expect that to go up too, but even though, let's say you're getting taxed at, I don't know, let's say a low wage, 15%. well, 15% on the previous $15 is X. But now if you're getting paid $30, even though the percentage is the same, now you're bringing in more revenue to the government. Now, if the price of food is up, sales tax is now more revenue to the government. So the point is this, whether it's products and services at higher prices, it's generating more taxes, whether it's payroll taxes, whether it's, income taxes. Of course, then after your income taxes go out, you'll spend that money. So more sales tax, so the cycle lives on.
Wow.
So that money now goes into paying off all of this debt. And so, yes, make no mistake about it. It's a tax there because your money, you now have to spend more for a said product. But in addition to that, sadly enough, your dollar's also been devalued 15%. So not only do we have to pay more because they have to pay more for people to even come back to work, but your dollar's worth less. So now you even have to add more dollars on top of that. So to answer your question, it is a tax, and it has been used as a tax. Is it being used now as a tax by design? I don't know if it's by design, but it surely is working. So
Wow.
yes.
Wow. Okay, I want to pause just for a second, guys, because we're kind of almost around an hour. This has been awesome, John. Just want to check in with everybody, how you guys are doing on time. I would love to keep going, and I mean for a little longer at least, and maybe we can talk for a second, John, for people who have to leave soon, of just I mean, this is a lot of information. I know my head is absolutely spinning right now because of all this, but how does this affect us right now? And even with, we've been learning about investing with this group, and yeah, like how does this tie together, and like how, in our decisions kind of moving forward, timeline wise, and yeah, what's the smartest way to go about this?
Yeah, good question. So I would say submit that the pieces we're talking about tonight apply to us in our investing. And I'm not talking about day trading, even though I do plenty of that, or my swing trades applies to that, but your true investing. And it makes it so simple. So the boring stuff that we're dealing with now, even though I don't find it boring, but I know everybody else probably does, if you even understand the high level concepts, not remembering them, but at least understand those concepts, then let me show you something here. And I will be brief. So the idea of inflation is this, and we've talked about it, is when the economy is sour, the Fed drops interest rates. Well, we're basically at zero right now. So, okay, the economy is not doing well. We looked at the velocity. It's actually getting worse, not better. If the Fed wants to stimulate the economy, they'd have to lower rates again, but it's at zero. So do you go negative? Possibly. Europe did. But because we've manufactured this monetary inflation, guess what? The only main tool the Fed has to fight inflation, this is funny, raising interest rates. So you have a decision to make. Do you keep rates at zero to help the economy try to get back up and running? And that will allow inflation to run, which will then tank the economy. Or do you raise rates now to combat inflation and slow down the economy now? So how does that help us, Nico? That's what I'd say is, well, if we understand this, and of course, there's another part of that cycle here, but if we understand this, we understand that what the Fed may be forced to do, if we see inflation rates get up at around 6% in the next month or so, which I kind of feel like we may see that, but we'll see. If they do, they may be forced this year to raise rates. Well, we'll talk about this more in our investing chapter when we get there. That brings us over here. Well, actually brings me over here. There's a simple relationship to remember about interest rates and bonds or treasuries, which are basically the same thing.
Well, 1 second, John. I just want to let you know, it looks like the people have spoken, and they want you to keep going, man. so don't feel too rushed. For anybody that needs to drop off, we'll send it. We're recording this. We understand, but it looks like the overwhelming majority is like, keep going, don't stop.
Awesome. All right.
They want you to start a podcast. That's what I'm saying.
I love it.
Got a couple requests for a podcast. Yeah.
I day trade for a living. I invest for a living. You're more than welcome to join me live and do what, I speak to myself. You're more than welcome just to listen in, which is sad, I guess. All right. So let's understand this concept then, because this will make part of your investing so super simple. And I'll show you a trick tonight that you could ride the rest of your life and make silly money. Though there's some caveats. So wait probably till the investing portion to make this happen. But understand this, the seesaw that we all grew up on. And if you didn't, I'm sorry, but the seesaw that we all grew up on, remember this: interest rates and bond prices. Bonds also, they're treasuries, corporate bonds, municipal bonds. And we'll talk about bonds another time. Most people like talking about stocks, but this is an easy trade. They're inversely related. When interest rates go down, bond prices go up. Now, the stock market has a lot of speculation built into it, right? So there's a lot of moving parts there. Bonds don't have speculation built in. It's a purely mathematical move, and that's it. So when interest rates move down, bond prices go up. Well, guess what, guys? Interest rates are at zero. Now, can they go down further? Meaning and there's a couple different things in there. I'm kind of being shorthanded about a couple things in the interest of time. But if interest rates go up, bond prices go down.
So you can short bonds is what you're saying.
You can, and I can show you how to do this, and not even short it. You can just buy an ETF, which actually does all the shorting for you, but you're actually holding it long. And also, just like a seesaw, if you remember when you sat really close to the fulcrum, you barely felt it move. Well, that's no different than bonds. If you buy a 1-year bond and interest rates move, you're barely going to get any appreciation or depreciation. But if you buy a 10-year bond, 20-year bond, 30-year bond, if the interest rate barely moves, you're going to feel it. So pros and cons. If you're in a 20 or 30-year bond and that interest rate goes up, you can lose 5% overnight in a bond. A lot of people don't realize that. And the reason people don't realize that, we've all been taught something that's not true. Nico, you've got to tell me, people who respond to this, who has heard this growing up? Bonds and stocks are inversely related. If stocks are going down, bonds are going up, and vice versa. Has anyone heard something along those lines anywhere in their life? Because I hear this all the time.
Sure.
Okay.
Yes.
Okay. That's the biggest lie.
People are saying yes. Yeah.
Okay, good. That's the biggest lie. And I'm going to show you why. And this, again, you're going to hear professional investment managers believe this is true. Stocks and bonds, let me be very clear. Stocks and bonds are not related at all. So where in the world did this idea come from? Well, very simply this. Interest rates and bonds. That's all you need to remember. Now let's go back to the chart. What did I talk about is when the economy gets into trouble, mostly in recessions, what does the Fed do? We talked about it. Who's going to answer it? Probably through Nico.
Yeah.
Nico, who's the first one to answer? When the economy gets into trouble, what's the number one tool they use?
Lower rates.
Yeah, there it is. Whoever answered that, good job. So let's think about this for a moment. When you come into a recession, that means that the velocity, we're going to tie it all together right now. When we get into trouble in the economy, what a recession literally by definition is 2 negative quarters of GDP back to back. So a recession doesn't even become a recession until the economy has slowed, because you actually need 2 negative quarters. And what is GDP? Really a measurement of, well, before we printed money, velocity of money. So let's tie it all together. The money, people aren't feeling confident about the economy for whatever reason, right? In different times. So money stops changing hands because they say, we may need this money. We're going to start hoarding it a little bit at a time.
It's fear in a way.
Exactly.
Yeah.
Now, we may not even know we do it ourselves, but many of us in uncertain times, if you're making a lot of money, people tend to spend a lot. If you are fearful of your own situation or the economy, you tend to hold on to a little bit more. So velocity starts to slow. Well, if velocity is dropping, guess what's happened to GDP? GDP comes down. If you have 2 quarters of velocity coming down, what does that make? 2 negative quarters of GDP, i.e. a recession. Now, if we're in a recession, that spooks the stock market for numerous reasons, and the stock market starts to sell off. The last recession, we saw 60% sell-off. Before that, we saw 50% sell-off. 2009, 2000, very similar to the 90s, 80s, etc. So the stock market's selling off. The Fed, the central bank, goes, uh-oh, we better do something. We need to stimulate this economy to get it back on track. What do? They lower interest rates. When you lower interest rates, what happens to bonds? They go up.
They go up, yep.
Bonds don't care what the stock market's doing at all. They care about interest rates. And every time we get into a recession, the Fed artificially drops rates really quickly. which pushes bonds up really quickly. And so the average person goes, and even not even the average person, financial people who aren't paying attention go, oh, well, stocks went down, bonds went up. The bonds weren't looking at stocks. They were looking at what the Fed did in response to the economy. And the stock market just responded to the economy. Remember, institutions are the stock market's not its own living being, and there's nothing random about the stock market. I make a living trading, so there's nothing random about it. I can tell you that for certain. I can show you trades I made today. It all has precision. But when you look at what the Fed does is, of course, when institutions are selling because they believe the economy is going sour and they don't think earnings from companies are going to be good, it sells off independently of everything else that's going on. It's just a response to a bad economy, and the Fed's responding to a bad economy by lowering rates. And by lowering rates, you mathematically move bonds. Bonds aren't speculative investments. You mathematically move them. So let me dispel that rumor. And if you work with any financial professional, I dare you to test them on this. It's the funniest thing to do. I do it all the time. It's great. All right. So that's the relationship there. I'm sure there was another question that I totally went off on.
I mean, tell me if I'm wrong and explain it this way. So it's almost like it's a perceived, it's like perception of like, it's an emotional reaction to a perception of what could or could not happen. Like that's essentially what we see. It's not.
Well, what part are you talking about? I'm sorry.
Oh, like when people start selling off, like when you know, when they start selling off, it's like not necessarily the company isn't necessarily doing anything different. It's just a fear of what could happen. You know what I'm saying? It's like, yeah, and that obviously affects things.
Yes and no. And what I'll tell you this, and again, I've been doing this a very, very, very long time, and it's how I make my living. This shocks most people. I don't read the news about any of the stocks I trade. Now, for investing, I do. Investing is a very different thing. Meaning for the long haul. I'm talking about holding on to a stock 3, 4, 5 years. You need to understand where that trajectory is going. But trading, I don't care about news. I care about the technicals, because the technicals on a chart, as an example, give me a second. I'll bring something up for you. Oh, perfect. This is a stock I traded today. And just to put this in perspective, I mean, day trading is no different than investing. It's just it's the exact same thing, just on a very condensed scale.
Yeah.
So let me show you something here.
So this is a mini preview to the investing course coming up.
Yeah. But this is what all of the big stuff we're talking about ties into this, because when you hear that the Fed is going to do something, the market's responding in a way, if you know how to translate that, which we'll talk about in the next section, you already know how to trade these things. And it's actually easier than you think. It just takes some time to learn it. But as an example, this was up almost 200% this morning. I love to short stocks, and it's easier to short stocks. But in essence, is what I'm looking for is I'm looking for oversold categories, meaning I don't know for certain that the market is absolutely going to tank when it opens up. So I let it kind of base out, and then I watch certain technicals. So to answer your question, maybe more importantly, is institutional traders who, remember this, retail traders, meaning like folks who trade in the market, they make up between 15 and 20%. On average, it's 15%. Since COVID, it kind of increased to 20, meaning a lot of people are trading these days.
Small slice.
Exactly. 80% of all trades are put in by institutions and block trades, meaning just, massive block trades. And they're not, unlike movies, they're not always sitting behind a computer making these trades. Some people are. But most trading is actually people sitting behind, watching technicals, plugging in if-then statements, meaning if it breaks the 200-day moving average, do this. If it breaks the 500-day or the 50-day moving average, do that. And what I mean is, I'm trying to figure out Tesla. Everyone knows Tesla. I'm always like, I need to find a stock everyone knows. So as an example, I'll show you how literally nothing's random is one of my favorite things to do. This little white line you'll see. Well, first of all, the white line is what we call the 20-day moving average, meaning at any point in time, it's the price it's the average price of the last 20 days. The green line here is the 50-day moving average. What you'll find is stocks have a personality. Tesla loves the 50-day moving average. So as an example for Tesla, I mean, don't get me wrong, there's a lot of caveats in here. Here. That was the intraday chart. I need to go to the daily chart. Each one of these candles is a day on this chart. And I take it back. This one, actually, the daily chart, it likes the 20-day moving average. But as an example, and we can go back as far as you want, and there's some chop in here, et cetera. There's ways to read this. But one of the coolest ways to trade Tesla is when it breaks above the 20, in addition to some other things that we'll review in another time, I simply buy it because I know the personality of Tesla. So you would have bought in here around the 450s. And where would you get out? Well, I'm looking for breakdowns in the MACD. I'm looking for breakdowns in strength. Because all this is, when you look at charts, it's no different than looking at the gauges on your car. Hey, what's my fuel pressure? How much fuel do I have? What's my RPMs? What's my speed? That's all technicals are. You don't let this scare you off. This thing called a MACD sounds fancy, sounds scary. No. If it's really far up, it tells me that it's a little overbought. If you see these lines cross, not to be oversimplistic, that means the trend is starting to break. It doesn't mean it always is, but it means the probability is in your field, whatever. And the idea is you want the most amount of probabilities to be on your side. Nothing is 100%, but if you can get the probabilities overwhelmingly in your side, you know to get in. So for my first thing is for certain stocks. And if you're trading big stocks like Tesla, Boeing, the boring ones, I like Tesla, don't get me wrong. This is actually quite easy. Getting in at 450 and I say, hey, I'm not even getting out until it breaks below the 20-day moving average. So I ignore it for months. And it goes from 450. It finally breaks down here. You'll learn how not to get faked out there, but you do get out here at 800. Making an 80% return in a couple months ain't bad. Most people like that over the course of 5 years. And so I'm a long short, meaning I'll short the market. It goes under the 20. Guess what I do? I short. So I make money on the way down. There's some chop in here. It's actually easier to trade than it looks. But the point of it is the market does not move by accident, meaning institutions also put their orders in for if it breaks down below specific areas, sell. And you'll see these massive sell orders go in when you break moving averages like the 20, meaning look at this, comes up, bounces to the penny off the 20-day moving average.
Crazy.
You think that's by accident? No, I could show you chart over chart. Look at this, bounces to the penny on the 50-day, closes to the penny on the 50-day. There's sometimes overshoot, so nothing's 100%, but you can see this, it comes back up, tries to break 20, fails. Once it gets above the 20, it bounces off the 20. So are these random places? No, they're not. And when you learn some basic principles, you understand how to trade these. Sorry, that is a preview of the next time.
Awesome.
We went over, John, the last class was all about indicators and we did cover the MACD. So hopefully this is seeming familiar to some of you guys. But yeah, we did the MACD and the moving average, actually, the 20-day.
All right, good. All right, so I'm going to finish up the cycle here. I did go on a tirade. Sorry. So actually, Nico, next time you're going to have to be like, Johnny.
No, I loved it.
Seriously off topic. Let's not do that. I can even review the trades from today. They're fun trades. But anyway, let's go back to the cycle real quickly, and we'll finish up on this and then entertain any questions. And I'm here as long as you guys want, seriously. So we print money. We devalue the dollar. True inflation, right? So DXY, if you want to be looking at that on like Yahoo Finance or whatever we use. You devalue the dollar, you create monetary inflation, not to mention the other types of inflation, meaning supply, demand, nominal inflation, but also the fake inflation we're creating through unemployment benefits, forcing prices up. We talked about that. But for this cycle, we're creating monetary inflation. You cannot get the cat back in the bag. If you ever tried, it's impossible. Inflation, then what happens to inflation is it will then force the Fed to raise rates, or raising rates will slow the economy. It will hurt the bond market. It will hurt the stock market because, again, you raise rates, you tank the bond market, as we just talked about here. You raise rates, you tank the bond market. Where the bond market goes, so goes the stock market, contrary to popular belief. That's a whole other thing we won't talk about today. But now the decision, this is the corner we've been backed into as a nation for the first time in our nation. But as I mentioned, it happened in London. It happened in Germany. It's happened in many countries in Africa. Worst case scenario, most people know, Venezuela. It's all the same thing, guys, for different reasons, guys and gals. Print. You devalue your dollar. You get what's called hyperinflation. Everyone's like, oh, goods and services are so expensive. No, it's not. Your dollars are worth nothing because you just devalued by, we just printed again. 1/3 of all dollars ever printed in American history were printed in this last year and a half.
Wow.
Talk about the devaluation of the dollar. So we have this monetary inflation. The Fed now either creates political suicide by slowing the economy and raising rates. So I would say that's in the long run, that's the best thing to do. It just slows progress in the short term. And typically politicians don't like to do that under their term. So will they do it? It's yet to be seen. If inflation continues up the way it is, if you let it run too hot, it gets out of control, called hyperinflation, like we saw in the 1970s, like we saw in the 1940s. And even if the Fed addresses it at a certain point, it's too late. And they're well aware of this, and hopefully they'll do something about it. And if inflation readings continue up, it may force their hand to raise rates. If they raise rates, you will bring down the bond market, you will bring down the stock market, you will slow the economy. Now, what I fear, and many economists fear, the worst is you slow the economy in the state that we're already in. What will the average public cry for? We need more assistance. We need more stimmy checks.
Yeah, we need help.
We need more printing. And then we begin again. We print, we devalue the dollar. So what is the answer? Unfortunately, it's actually very clear. It's just political suicide for both sides, whoever does it. You stop printing and you stop these benefits, and that hurts a lot of people, unfortunately, and it does. But at least you stop devaluing the dollar and crushing your actual country for decades to come. Or you raise interest, and you raise interest rates, which will bring down all markets. Make no mistake about it. And there are ways to actually take advantage of that. It will bring down all markets. It will slow the economy. But that's actually how you heal the economy. You go through these recessionary pullbacks, these 50% pullbacks in the stock market. Beautiful buying opportunity. Capitalized on it for our clients in 2009. And I hate to say it this way, if you're lucky, not from an economy point of view, not from our friends and family, but if we're lucky from an investor's point of view, we see a recession every decade. And we have. And when you see that recession, you get that opportunity to buy stocks at a 50, 60, sometimes up to a 90% discount like we saw in the 1930s. And don't discount that. That can absolutely happen again. Not that we don't expect it, but it could happen again. Those are the opportunities that will make not only your lifetime, but
of a lifetime.
Generations. Yeah. In 2009, we doubled our portfolios from 2009 in 3 years. In 3 years. Now, don't get me wrong. If you're day trading and swing trading, you can do that much faster. I was just showing Nico before this that I'm up 51% this month alone. Actually not even this month, this last 2 weeks. But that's riskier trading. That's not investing. But solid investing, being able to double your portfolio without really having to do much in 3 years. That's the opportunity that recessions bring investors. But make no mistake about it, and I'm not making light of it. The next recession, because of what we've done from printing all this money, will probably be worse than 2009's recession from a country point of view. Make no mistake about that. The numbers are there. This is not my opinion. This is just reading the Federal Reserve's economic data. Velocity is already at lower lows than it's ever been, and it's going lower. We've devalued our dollar. And on top of that, there's another topic we talk about called repos, where there's so much money sitting in the banks that they're getting penalized. So they're sending it back to the Federal Reserve, and we can monitor that. And so the other part of inflation, and I'll close on this, we think inflation's bad. Where you get hyperinflation is what happens to Weimar Germany and Venezuela and what we've just done. Now, can we escape it? Probably, hopefully. We're Americans, hopefully, right? But who knows? Maybe not. There's not been an exception to the rule yet. So it's simply this. We now have these trillions of dollars sitting in the bank in personal accounts because people are hoarding it. And we can measure that. Funny enough, I don't think people realize that everyone's banks are monitored. We know how much money is in everyone's account. Not personally, we just know as an aggregate. So we know how much is sitting there. Let's say even a best case scenario, the economy does get better, right? Some miracle we heal over the next year. Sadly enough, that could be the worst thing for our nation. Because if the economy heals and that money comes out of that bank account and goes into the economy, not only do you have now monetary inflation, but your nominal inflation will skyrocket because you have massive amount of demand, money flowing to a limited supply. And we've seen that time after time, 1970s, 1940s, when you have money chasing product or products down, and it skyrockets inflation. So the inflationary effects that we are backed ourselves into a corner this time around are unlike anything we've seen in America's history, but it's rinse and repeat stuff, guys, that we've seen from, again, all the way back to the Roman Empire. It is nothing new under the sun when it comes to that. And again, monetary inflation, nominal inflation, and if that money comes out of those banks, which eventually it will, and gets spent, if it's spent quickly, it creates massive inflation. Slowly, we can deal with that. And then, of course, these unemployment benefits are creating inflation. So inflation is the name of the game, guys. And so the answer now is, what's the Fed going to do if they raise rates? That means dropping the markets. That provides opportunities for us investing wise. That leads us to our next chapter. That's why all of this is so important. Because if we jumped into saying, hey, interest rates, this, if they go up and down, but now you know the mechanisms, you know the gears, you know the levers. And really, these levers and mechanisms are the only true ones that you should care about as an investor in really the economy. And if you understand, I wouldn't expect you to be able to repeat all this back to me. If you can, that's amazing. But if you even understand the concepts of these, you do know more than 90% of true financial professionals out there. And I know that because I give the same lecture to financial professionals, and they question it all the time. They're like, well, what if? I'm like, look, this is just mathematics at the end of the day, guys. So,
Yeah. Wow, John.
So I'll take a break there. I know I've talked way past my time.
We got some questions. This is so good, man. Okay, trying to go back here. Let's see. Question. What is the impact that this will have on the poor?
Very good question. Oh my goodness. Okay. Yeah, that's good. That's very good.
Okay, so that's one. Next is let's see. Have we already seen have we already seen that inflation rate changes, or are they still upcoming?
I think that's Micah.
Inflation.
Where are we in the
Where are we in the circle?
Yeah, in that circle you drew, like where are we currently?
Yeah, well, we printed money all this last year. The dollar's been devalued. We looked at that on a chart. So the dollar does bounce around. Why? Because other countries are also devaluing their currency, which again, it can raise our dollar up. So make no mistake about that. That does help, but there's no end in sight with our printing. As a matter of fact, we're about to print 2 trillion more and send it to the IMF for another country. It's a whole other thing. But the same premise is that our printing presses are running hot, and I think we have unlimited ink apparently. So where are we? Well, we are in the inflation. We're right here between inflation and the Fed. I mean, right? So last year, the Fed said, hey, we're keeping our rate at 0 to 2023. No way, no how. We've got this, guys. Well, let's keep this in mind. The economy supposedly recovered after 2009, but the Fed couldn't raise its rate off 0 till 2016. 7 years of 0 interest rates. The reason you need to raise interest rates is it's your dry powder for the next time you get into trouble. When you get into the trouble, the Fed has to use your interest rates. And if they don't have interest rates, guess what's the next big thing? Printing money. It's new. Printing money in the quantities that we are doing is a new experiment in the modern age, but it's not new when you look back at history. Meaning, again, you have to really go back to the Roman Empire, really, and some of those as you go through history, then, because that's what they would do. But it's relatively new again, back on the scene since 2009. So interest rates are going up. Inflation is going up. This month's reading was 5.4%. And here's an interesting fact on that, delving a little bit deeper. Technology is deflationary. Let this blow your mind for a second. We always think of things going up in price. Believe it or not, a great study of the economy, and I sometimes come across as anti-government. I'm not, but I'm just telling you, when the central bank gets involved in things, they make a mess. In the early 1900s, before our central bank, we actually lived in a deflationary environment where every year things became cheaper and cheaper and your money actually went further and further. Now, why is that? Well, it's very basic. Let's say you're a farmer and you have to plant everything by hand. You have to charge for that time, being very simplistic about this. Now, all of a sudden, let's say technology comes about and you have a tractor that can plant, 1,000 times faster and pick things 1,000 times faster. Yes, you still have the cost of the technology, but ultimately over the course of time, the products of those products that you're harvesting actually come down. More to the point and probably easier to understand. Have you ever bought a computer and then the next year said, gee, I think this computer's worth more than it was last year? No, it's usually worth half as much. a car. You drive it off the lot, you lost 25% of the value most of the time, depending on the car. Not all cars.
Yeah.
But the point of it is technology is deflationary. So here we are, we have the Fed looking at inflation, and what are they measuring? The third metric in inflation is used cars. Of course, used cars have spiked lately. But are we measuring technology as a part of an inflationary number when they're saying, okay, so we're looking at used electronics or used technology as part of our inflationary numbers? Well, of course, inflation is going to be lower than that 17% drop in the US dollar, because US cars, used cars, even though it may have a blip on the radar in pandemics, every year they go down in value. So, are we looking at refrigerators from the Sears catalog? I mean, all of this stuff is cheaper every year, and yet we're measuring that as part of inflation. It's a fugazi. Now, the reason they have to do that, it is by design, make no mistake about it, is Social Security, government pensions, all of these cost of adjusted livings are adjusted on inflation. So if we really said, hey, inflation 17%, we have to adjust all these payouts that the government pays out by 17%. We couldn't afford it. So there's a design why you cannot actually have true inflation reflected.
Wow. Okay.
Sorry, repeat some of the other question. Oh, what is the result on the poor? Yeah, that's a very good question. This is look, I know probably half the things I say grind the gears of some folks. I get it, because you can't go down into you can't go a mile deep without spending another hour on either one of these. So I don't want to be cavalier about this topic. But I go off data. I'm a data guy. I'm an engineer. I'm a satellite engineer by trade. I just learned satellites and decided to trade instead. But that's why I love numbers so much, is when you look at the numbers. Yeah, I mean, I hate it. Politicians on both sides plays with numbers all the time. If they're trying to pitch a bad thing, numbers are terrible. Good thing, opposite. And as an example, we hear about, and again, I'm not choosing one party over the other, but probably the biggest debate that you hear in the financials is during the Reagan timeframes. This trickle down economic, thought never worked. It's like, all right, well, actually trickle down economics was actually never a term used in a positive light. It was a derogatory term derived by media. But the idea is, okay, you cut taxes and, it trickles down. That's the idea behind it. Did it work or did it not? Well, let's talk about that for a moment, because it applies to today. Is what happens is people look at data sets and they say, well, look at the middle class. And the reason this is a hot topic, President Biden came out today or yesterday, days come together, and said, have you ever known a time where he came out saying the middle class continues to shrink while the wealthier become wealthy. So of course, on the face of it, there is some truth to this. This isn't linear, right? But on the face of it, it sounds like, well, that's terrible. It sounds like even the middle class is shrinking. That's, well, great. But the question that's never answered is, if it's shrinking, where is it going? Is it going into the lower level? Or wait a minute, if the wealthy are getting wealthier, is it possible to look into the data to say, well, maybe some of the middle class are getting into the upper class, and maybe some of the low wage income earners are going into the middle class? You never hear that discussed, though. You can look this all up on the Census Bureau, or not census, oh gosh, I'll have to look it up. I have all that data. You can look it up. It's pure data. And so, yes, the answer is, even during Reagan's time, the middle class shrunk. So you hear that all the time. It shrunk. Terrible thing. And yet the high income earners, or the wealthy, increased by the exact proportion that the middle class shrunk. So what that shows is that the middle class did shrink, but more people became quote unquote wealthy based on what it was looking at. And actually, even the low income wage earners became part of the middle class, even with the middle class shrinking when you look at the numbers. So it's all in how you play with these numbers. Now, that's not a pro and con for trickle down economics. It's complicated. But the point of it is, it's back in the news now, is we need to raise taxes on corporations. We need to raise taxes. We need our fair share from the wealthy. Look, I don't believe that. I don't think most people do, because in reality, it's not that they're not being taxed enough, it's that there's loopholes, right? If you really wanted to satisfy some sort of, help out, take from, or tax more, you don't need to increase taxable brackets. You need to get rid of these loopholes that we just saw Jeff Bezos, who is an adamant opponent adamant for, we need more wealthy people paying. And yet his taxes were leaked and he pays zero. It's like, all right, you're the one preaching it. He's not doing anything illegal. He's just taking the legal loopholes. So don't increase tax brackets, shut down loopholes. So to answer your question, Juan, what does this all mean is this is politics. What you're looking at on the screen is politics. Raising the interest rate, it's going to be political unless their hand is really forced to address inflation, right? We'll see what happens. This will hurt the poor. And you know what will happen in this cycle? The poor will get hurt if this is what we continue to do. And what will happen is we need more government assistance. We need to print more. And the cycle will continue. Because the problem is the poor have already been hurt. It's just not realized yet. The poor were hurt. And again, this isn't partisan. The printing began under the Trump administration. It just continues under the Biden administration, right?
Yep.
So it already occurred. The minute we turned on the printing presses, it already occurred.
Damage
it just
done.
hasn't been
Yeah.
realized yet.
Hey, John, I also want to say that I think that understanding these cycles, wrapping your head around how these cycles operate, that education is critical. I mean, you got 21 people right now on this call that are learning, a different way of how to respond to, these economic levers, right? And I feel like that makes a huge difference. I can say for anyone that maybe went through the 2008, 2009 recession, without this kind of knowledge, you get wrecked. You can lose, you can sell at the bottom. Even some basic investing principles, not having them in place can really hurt your long-term wealth building capability, just not knowing those simple things. So I would say that education plays a huge role in this. And I mean, it's literally one of the purposes of why we're all here is to, you didn't see this, John, but we put up a wealth gap chart of minorities. And it just hurts to even look at it. It's so off. The gap is so wide. And it's because of the financial, I read a bunch of reports on it, and it's because of the financial assets that the individuals own, period. Like that is the factor that is changing this. And how are you going to own financial assets if you don't know how to buy them? You don't know how they work. And maybe you don't even care to know, right? So I think the education is like extremely important. And we throw that term loosely, education, and people just go to school, but it's like learning the right things though. There's like a few really key things that if you learn them and you wrap your head around them, they'll change your life completely. And that's why this, this program exists, so we can teach those very specific concepts. So, like what you just did today. So that, we're really grateful for that.
Well, I'll put a last point here, as I've been happy to stick around as long as y'all want. But here's some easy trades that we'll talk about next time. But as an example, this is Tilt, TLT. And I'm not ever saying that you should go out and buy this. There's a couple things you need to learn about trading before you do. And this isn't trading. This is investing. Talking about the most boring investment you can get into is a treasury, but you can make some serious, easy decisions on this. So this red line is the 200-day moving average. For very boring investments, you just need to look at the 200-day moving average, because when you're above it, you should be in it. When you break below it, you should get out of it or short it, one of the two. So as an example, this is a treasury. This isn't even a stock. It looks bumpy, but believe it or not, this is super, super conservative. But the idea is, just being very simplistic on this, is that red line. If you buy when you're above, plus a couple markers, don't get me wrong, there's a couple things there. You would have bought in back in December of 18, and you would have ridden this thing from basically 118, let's round it up, 120. And look, this peaked out all the way up here at 180. So, all right, and there's some rules to take some profit when you get way away from the 200. There's some rules there. But the point is, this is a very conservative trade. So ideally is, if let's say you really knew nothing, but you knew that inverse relationship that we talked about. And I mentioned, I am going to stop here. You have bonds, which is basically a treasury as a bond. Well, let's look at really quickly I'm going to just overlay the 10-year treasury yield just to prove my point here. And it takes a second sometimes. Maybe. Okay, there it is. Oops, there it is. That purple line that just showed up, right? Now it's over exaggerated, but look at this. When the treasury or when the yields go down, bonds go up. Guess what? When the yield was going up, the bonds were coming down. Look what the yield is doing. It's going down, bonds go up. It's just an inverse relationship. It's a mathematical one. It's very easy to trade. But more to the point, if you understand what we just talked about, and we'll get more into this when we actually, there you go. When we talk, here's an easy trade, something you can back test. And again, there's a few caveats we can talk about another time. In the 200-day moving average, if you got in, it would have been December of 18 at basically 120. You would have, let's say you didn't know to sell at a high or anything like that, and you just said, I just know to sell when it breaks below the 200. You would have sold at 160. This is a bond, guys, not a stock, right? And what is that? Like, my math is bad without a calculator these days, which is sad, but like a 30% increase in from 18 to 2000. I mean, 2 years. Most people are happy when I manage portfolios. People are happy when you're like, 15% for the year. You're like, all right. And that's in stocks. This is bonds. So look at this, down below 200. You either short it, which I do, and it's very easy to do. And you say, okay, I'm going to ignore it until, a couple things. But if you're just being a clean technician about it till it gets above the 200, it just got above the 200. Now that is an entry. Don't get me wrong. There can be chop there. Nothing's 100%. But the point of this is if you can trade some of these things very simplistically in a strong investment portfolio. To Pablo's point, too many people, unfortunately, we work hard, we make dollars, we put those dollars in the bank account, and meanwhile we're printing like crazy, and so we're losing buying power by 15, 17, maybe 20% of the money that we worked hard to save. So we need to find some vehicle, conservative many times, like just an easy trade that we don't have to look at every day, but maybe once every month, to be able to get in so that our money can, at least at a bare minimum, keep up with the inflationary effects of our central government who wants to print. So that's the point of this. And all those things we went through is, though, that's the gears that are moving the market. How do we combat that? And how we combat that leads into the investment piece. Is we can't just sit on the cash that we earn, because it's eroding. It is a tax. Someone asked that earlier. I think that's the best way of saying it. It is a tax, intentional or otherwise. So, yeah.
Wow, John. Okay. Is there some kind of GDP per capita measurement?
That's a good question. There is, but not as a measurement of GDP, if that makes sense. You can boil it down. Let me see. I think I might even have that up here.
We had a couple other comments.
I had a
all
question.
your crypto, Ryan.
Crypto. I love my crypto. Yeah, gosh, I actually know it's in here somewhere, to be honest with you. But here, gosh, it's in here somewhere. But one of the biggest things you can look at too here, this is kind of interesting. Our debt right now per taxpayer to pay it off would be $250,000 each person. But if everyone paid taxes, it would be about 85,000. But anyway, this is actually, you can look this up. It's called the U.S. debt clock. You just Google it, U.S. debt clock. It has all the numbers that would answer that question as well. Wow. It's in here, so it's buried in there somewhere.
I see Jess's question. Do you think assistance printing money will actually stop this fiscal year?
A good question. So the answer is always no, because as we looked at before, is they're always printing some, right? So the answer is that they're always going to print some. But in these mass quantities, you would hope so. What you're going to listen for in the news, it's called tightening. Are they tightening? Yeah. And really what that means is, are they slowing? It doesn't even mean they're stopping. Are they slowing the printing? You would hope so, but I've got to say that cycle is what we worry about, because again, when you do that, it will slow. Look, it's like anything, right? Sometimes you have to rip the Band-Aid off and make it hurt first before it gets better. And just like we're doing, right? If you start cutting unemployment benefits, if you stop printing and doing stimmy checks, if we don't see that happening. Why? Because they're instituting new ways of doing it. If you have a child, get this. I get a check in the mail every month because I have a 2-year-old child. I don't need it. I don't even know if I qualify. There obviously wasn't a qualification for it. So why are we printing money and sending to people who really don't need it? So to answer your question, I just feel it takes a different form. In addition to that, a lot of people ask me is, okay, if many lead economists that I follow, again, brainiacs beyond brainiacs, I just read their white papers and absorb the information. That's, I would never pretend to be as smart as they are. But most of them do agree that the US dollar has started the apex, meaning we took over for the pound sterling. We've kind of run our course. We're doing the same thing that every great reserve currency has done, devaluing ourselves. We've run our course. Now, what does that look like? Doesn't mean we disappear off the map. London obviously is still there. So somewhere between a London and a Venezuela, right, is where do we land? But the thought is that in our lifetimes, all of our lifetimes, we will no longer be the reserve currency. Is that 15 years down the road? Is it 20? Most economists believe it's between 10 and 20 years down the road. What does that look like? Who takes over for us? The answer to the question that you just asked plays into that is most people say, I don't know why. They say, would it be China? And the answer is no, because to be a reserve currency, there's so many stipulations. They wouldn't want that. They don't want us to be the reserve currency for numerous reasons. But the idea that it may actually be, and this is something to write down. You talk about tinfoil hat stuff, but it's not. It's you can Google it. Is these things called SDRs. It stands for special drawing rights. And to oversimplify things is every country has a central bank. Ours is the Federal Reserve. Sitting over top of them is a ultimate central bank called the IMF, International Monetary Fund. That's way an oversimplification. It's not that simple, but
Yeah.
the IMF basically oversees all that. So as an example is in the 1944, when we became the reserve currency, we had this thing in the 1960s called the Brentwood Accords or Brentwood Meetings. And in essence, is most developed countries backed their debt in US dollars because we were the dominant currency. Well, in essence, is the IMF was then saying, well, wait, we need, if the US dollar grows strong, then other currencies won't be able to pay their debts because all of a sudden they owe more, comparably, how that works. So we need some sort of equilibrium. They can't print US dollars. The reserve currency, we can print more US dollars, obviously, but other people can't print US dollars. So the IMF over here has this thing called special drawing rights, which they have their own printing press. Called special drawing rights. And they've been used over the years to help countries where if they're suffering and if our US dollar grows strong, they're able to lend money to them. SDRs, keep in mind, are basically US dollars just sent to the IMF, just so you understand that. Mm-hmm. And in essence so Janet Yellen, who is now head of the Treasury, was head of the Federal Reserve under the Obama administration. Now she's on both sides of that, right? Now she's played both sides. The head of the Treasury does not need permission from Congress to give money to the IMF. They just need permission from the administration. Well, the Janet Yellen under the Obama administration was very strong on, hey, we should eventually work our way towards one world corporate tax rate. If you haven't heard that lately, you haven't been listening to the news. And she was also big on one world currency eventually. Well, there was no real catalyst, right? There was no need for that. Well, now she's head of the Treasury, which, it's funny she was talking about it as head of the Fed because that was not her position. It was Treasury that needed that. She's head of the Treasury. We have a pandemic. Now there's a catalyst. And so the IMF came to America, or US in this last year and a half, said, wait, just like you guys turned on the printing presses to help out your citizens and your businesses, we still have countries that are hurting and we need to print money, these SDRs. Well, where do they actually print from? Well, the IMF is a conglomeration of different monies going into it. Funny enough, US makes up 50%, just shy of 50% of the IMF. So in essence is Janet Yellen wants us to print another $2 trillion. So we just printed 3.5, pretty big deal. But she wants to print another 2 trillion over this year and next to send to the IMF so that we can help out other nations. First on the docket is China and Russia. You can't make this stuff up. You can Google it. It's in her own speeches. Literally, I listen to her this is my job, right? I listen to 3-hour speeches on, and it's all on Google and YouTube. This is not tinfoil hat stuff. You would think it is if you had never heard this before, but simply Google it. SDR, type in SDRs and Janet Yellen. It's in her own speeches. It's not hidden. It's something that's being pushed. So the answer is, could SDRs be the next currency after the US dollar does start to fade? Possibly, very possibly, because that was the design of it in the 1960s. Looking forward, there was just no catalyst.
Hey, John, I see a question here that I think it's probably what everybody's thinking right now is, this is a lot of information, a lot of levers, a lot of things to digest. But somebody wrote, how do you prepare your 401k for a recession? And maybe the larger question here is, what do we do about this? Like, is it typically because the levers, now how to invest accordingly, and then therefore take advantage of whatever situation is presenting itself and trade appropriately? Or are there other things that can be done to kind of, position yourself in the best situation, knowing what the history happened with London and with other things? like what can we expect, and or more importantly, what would you do in that position?
Yeah, good question. Very good question. So the reason we go through all of this craziness, and yeah, it is a lot of information, but I'll also tell you this, even though I like to go in my little factoids, the information we covered tonight is really all you need to know with regards to the levers and gears. There would not be another one that pops up that would radically change anything about how we view the markets. There's history upon history that I like to espouse upon, but you now know, or at least have heard tonight, everything that moves the market. So to answer your question, this is the S&P, right? The overall market. I will tell you this. I personally, whenever I work with my personal clients, right, is I don't let them, most people just want to know, hey, what do I do with my stocks and my bonds? I don't care about what's going on in the economy, but I don't let them get away with that, because for me to explain what to get in, with you now knowing, or at least hearing what you heard tonight, I would submit that when we get into the investment piece, everything will make absolute sense. But if I were to say, hey, we should take some off stocks here, we don't be in small caps, don't be in mid caps, look at international. We were getting that. At this point, it'd be like, okay, but why? And we'd say, well, do you remember, because of the interest rates doing this, this does this, this does this. Because interest rates are doing this, this is the way to be positioned. So we addressed the levers tonight. And when we talk about the investing, we'll talk about, okay, when this lever is pulled, i.e. interest rates, how do you position your portfolio? And this is not day trading, right? This is investing. When a lever changes, it will change the trajectory of the market for 2 to 3 years. So how do we position? I'll give you a very high level answer, and then we'll definitely go deeper. Don't make any changes to your portfolios based on tonight, because there's always some caveats. But let me give you some perspective here for a moment.
Look at that rising wedge. Whew.
Oh yeah, well, so yeah, did you guys talk about rising wedges?
Not yet.
Well, and technically,
yeah,
technically they're called, I call them pendants. But what's interesting is you'll notice they typically come in threes, and they typically increase. And this is no different. Small wedge broke down, about the size of the wedge. Bigger wedge broke down. We're about to break down, folks. And so actually, I would submit to you that just don't run for the hills. Most true technicians believe the market can crash over the next year or two, 60 to 80%. No promises there, trust me. But that shouldn't be something to fear. You should almost want that if you know when you know how to position yourself. Now, keep this in mind. I got derailed.
Sorry.
Yep.
Yeah, no. This is what I wanted to point out. Why there's no rush necessarily. We don't expect anything can happen, but we don't expect a COVID type pullback. What do I mean by that? COVID type pullback was a 37% drop in the market in 3 weeks. We call it a flash crash. Granted, it was a pandemic. We get it. But we don't expect that. A true recessionary crash is this. This is the year 2000, the 90s bull market, 2000. Let me put this in perspective, because these don't look like much. This is a 50% crash, okay? But this is also 2.5 years. All right. Now, this is a weekly chart, not a daily chart. So again, a couple things I would point out to you. If you wanted to be just you don't want to get an individual stock picking, if you just want to buy an index fund, what you'll notice on the weekly chart, and again, don't memorize this next time. This was just proof and concept. The 50-day moving average on the weekly chart works just fine for investing in the markets. Meaning, if you're underneath of it, you're either short or you're not in it, or, be careful. Because watch this. Yes, even though you can get faked out a few times and you may have taken profit, you can jump back in when you get in, because it doesn't happen very often. In 1998, it happened again in 1999. And the more often it happens, it's like jumping on a plywood floor. You start to hear it crack, and meaning kind of like a bouncing ball, I guess, more a better analogy. It hits harder and harder. You're eventually going to crack. And when you finally crack and it comes back up, and there's a couple things, you get out, but where would you get back in? You could have had a fake out here. But again, a couple things we would have looked at. Ideally, you get back in here. That's in 2003. And you could have ridden that, and we'll talk about these in another session. You could have ridden that all the way to 2008. But the point of me showing this is a recession, a normal recessionary pullback, has lots of ups and downs. But this was 2.5 years from the height to the bottom. So even if we began tomorrow
you have
to see a
time.
recessionary pullback, the opportunity isn't going to be there for maybe 1 or even 2 years. So keep this in mind. Recessionary pullbacks in the market have happened quicker and quicker each decade. Has to do more with technology and how we trade. This was 2.5 years. The 2009 recession doesn't look like much, does it? This is a 60% pullback, but that was 18 months, a full year and a half. A full year and a half. But the problem is most people don't panic when your portfolio is down 10%. They maybe not feel good when you're down 20. Most people start panicking over 30%. And by that time, you're already halfway to your destination. But that's when people start selling and you actually get what we call waterfall effects. And that's what you see in almost every recession. That's a waterfall effect. When you get down to a pain point where usually 30, 40%, you get mass capitulation and going, I can't take it anymore. And unfortunately, people even take their lives over this because they're invested poorly. But look at this, you're under major moving averages. If for nothing else, you're under the 200. If you're under the 200, you have no business being in the market, just an FYI. I mean, like you should be shorting the market, have nothing to do with it. Once you're back over the 200, I mean, you know, you're good. I mean, you can't make this stuff up. In 2015, we bounced off the 200. In 2018, we bounced off the 200. This was scary. The COVID, we dropped through it. There was some real concern that we would not recoup, but then the printing presses turned on, devalued the dollar, showed up in inflation in the stock market, pushed us up, made this rising wedge. But the answer at this point, of course, will be in the next. So to answer your question more specifically is everyone wants to top tick the market, get the absolute last day of profit. You're never going to be able to do that on purpose. Don't try. This is your life savings. Are you going to risk, a 50% pullback on your life savings? No, it's a strategy. Is when we know the economy is not good, it's not. When we know that that you're on a tightrope and you fall one of two ways, and both ways will tank the market. Either inflation runs too hot and it brings down the market, or the Fed raises interest rates to combat inflation, brings down the market.
Right.
In the meantime, we're still going up. So what have we done for our clients? Well, if a client, let's say, was 80% stocks, they're probably closer to 50% stocks. Now, that's a gross generalization based on needs and age and all that along there. But the point of it is, we look at this as an opportunity. You sell into strength, meaning when you have an obscene strength, take profit along the way. Not everything. You take profit along the way and you stick it into dry powder if all these pieces are on the table for a strong pullback. And we wait for that strong pullback. We invest in the lows and the stocks that remain in the market. Now, so I'm not an advocate of ever getting 100% of stocks ever, meaning clients who are in 50% stocks, when we come crashing through the 50 and the 200, I'll give them the option to say, we probably have more to go. But in reality, you should already be positioned a little bit, at least a little bit more moderate than you typically would be. And the people, your friends and family, will think you're crazy because the market just keeps going and going and going. But we now know why. It's not because of a good economy. It's because of the devaluation of the dollar. It's because we print money. So when we talk about investing, it's very easy now to say, this is what we're doing because we know what's happening. But your average neighbor and family member will go, why wouldn't you be in the market, man? I made 15, 20% this year. Like, yeah, and you're about to lose 50% of not just this year's, but the last 10 years in the next year, potentially. No promises there. But what I would end on this word picture is, I can't tell you, no one can, if I'm looking at your car and you have a tire with no tread and the, rubber's hanging off of it, I can't tell you at what mile marker that tire is going to blow. But I can, from a technical analysis point of view, tell you, you have no tread, you have rubber hanging off. You probably don't want to go on a road trip. And that's where we are. Everything we talked about tonight is the rubber hanging off and no tread left. Can we limp along for a few more miles? You betcha. Can we print more money, devalue the dollar, push the market up? You betcha. But what trumps that, meaning if you continue to devalue the dollar by printing, doesn't the market just always go up? No, because the minute the Fed flips the other lever of raising rates, you're going to see that trump the devaluation of the dollar and bring down the markets. So again, these all build upon each other, and you're going to hear me repeat these things over and over and over. There's nothing new that you'll hear from me with regards to the economic levers. So you'll get used to hearing that. But what you want to make sure is just take some profit off your equities, mostly focus on larger companies, ideally focus on companies that pay a strong dividend. Because a strategy that I would tell everyone to get into in recessionary type times, because what if by some miracle we don't see a recessionary pullback? That'd be awesome. But let's say that by some miracle we don't. but let's say we do see it actually. So you're taking profit off and you're putting it to the side. We'll talk next time what the side actually means, because you don't want to just lose it to inflation. But we're taking some profit off and we're putting it to the side. If we just say, okay, well, now we have less stocks than we had, I get it. I may not get all the upside that continues, but now I have stocks also that pay me. Well, let's say the market falls 30, 40, 50, 60, 70, possibly 80%. Who knows? Yet to be seen. But in the meantime, as it's going down, every month you have dividends coming in, because every stock pays on a different quarter. So every month you have dividends coming in. When's the best time to buy anything? When it's on sale. Well, here's a dual strategy. We have money sitting off to the side to wait for the ultimate buy-in at the lows, when technicals tell us, when lows, plural. We'll never get the absolute lowest day, but the lows. But in the meantime, while we wait for that, your stocks that, yes, in the meantime, will lose value and it won't feel good on your monthly statement. But your share size will go up and up and up, because you have those dividends coming in every month, reinvesting, and your 22 shares turns to 23, 24, 25, 26, and your value still drops. But when you come out of it, as an example, in 2009, this strategy that I'm talking about, now, obviously it depends on what stocks you have, but the stocks that we had, when the market was down 60% from peak to trough, the stock portfolio that was focused just on boring, solid companies that paid a boring dividend, meaning 100% stocks, that piece at least, was down 22% when the market was 60. Now, 22% still doesn't feel good, right? But it's better than 60. And that portfolio that we used broke even after one calendar year of hitting the bottom, versus it took from 2008 to 2009, when that came down, we didn't break even until 2013 in the market. So it took 4 years to get back up there. So the point of it is dual strategy, focus on solid companies, dividend payers, so that they're paying. Dividends seem so boring, but in recessions, they're so important because they're buying that discounted price every month. And then we move in at the end by putting that dry powder that you took off at the top in, buying at lows, and we ride it into the next bull market as long as our country's still around. So,
Right. So good. Well,
now I've
guys,
taken up 2 hours of y'all's time tonight.
Yeah, no, John, this was great. I really appreciate it. Thanks for everyone that stuck around. We'll send out some notes, and I think the exciting thing is this is a perfect segue into the investing sessions coming up that are going to be, really around, just the basics of investing, how to start, and just, a couple of simple strategies. And I think that, getting a good group of people that are interested in that and building some momentum on it's great, man. So I really appreciate you taking the time, John.
Yeah, John, thank you.
Well, I appreciate you all bearing with me, because I know that we took some complex issues, boil it down to a short amount of time. And sometimes that's not ideal, but I appreciate you bearing with me, everyone, and letting me talk.
Yeah, lots of feedback. I mean, everyone's just saying thank you and incredible stuff. So yeah, we really appreciate it, John.
Well, thank you.
Thank you, everyone, for coming.
Thanks,
we can't wait for next week. It's gonna be amazing.
Take care, y'all.
All right, see you guys.